Alright, this is our last lecture of the short semester, Lecture 11. It's on Chapter 11 out of the textbook. It's on capital budgeting. Capital budgeting is the process of planning for long-term investments in fixed assets, what we call CapEx, which is capital expenditures. So the first thing I have on here is types of capital expenditures, just to give you an idea of the types of things you might do capital budgeting for. So for starters, there's replacement projects. These are in maintenance projects. That's probably your most common but least important type of capital expenditure. It's fixing real-world depreciation. So we usually think of depreciation as in finance, we think of it as a accounting item where it's a non-cash expense and it writes your taxes off. But there's also real-life depreciation where stuff breaks down and you have to fix it and you have to maintain your property, plant, and equipment to make sure it keeps producing whatever it is supposed to produce. And then there's also what we'd call cost reduction replacement projects, where you might replace a piece of machinery with a new piece of machinery that saves you some money. You're not really expanding, which is our next category. It's not really an expansion project. You're not doing anything new. You're just finding ways to do the same thing cheaper by buying new equipment. Expansion projects obviously are where you're actually literally expanding and doing something new. So the much more common would be you're expanding within your existing product line, which means maybe let's say you own a retail shoe store, and then you're trying to decide if you want to bring a new brand of shoes in next year, or a new style of shoe from the same brand. I mean, that's a common decision you're going to make every year, and so it's not going to be that big of a deal. So it's going to be, you're still going to put some planning into it, but it's not going to be as big as, say, if you're going into a whole new product market. You're going to put a lot more planning into it. It's going to be a much higher level decision if you're going into a whole new product line, something you haven't done in the past. So the different type of project is going to determine how much planning you put into it, and then what level of management does it have to go up to before they actually get to make decisions. And then there's some kind of others down here. I actually have an other category, but for example, like compliance projects. These are common projects you have to undertake because regulations change all the time. The government's coming up, at least here in the US, for example, they come up with new environmental regulations every year. So maybe they come out and say you have to use equipment that uses less electricity, less energy, or pollutes less. And you might have to go out and replace your equipment even though you don't want to, just because you can't break the law, they'll shut you down. Or it could be safety issues, things like that. And then there's mergers is another category in here, which is a whole animal of its own. If you want to merge with another business, some businesses do this a lot. Especially large public corporations that have it's easy for them to raise capital. They might merge a lot, but that's it's like a really large expansion project where you're looking at a whole nother business and you're going to go in and do your due diligence, and you're going to look at their past balance sheets and income statements, and you're going to forecast, how's it going to change your sales in the future, your expenses, is there going to be any synergies, any economies of scales, economy of scopes, things like that. So that's a large project. And then other fits in sort of that thing that doesn't fit with anything else. It could be maybe the management team wants to buy a new jet to fly them around the country or the world. That doesn't really fit in any of these other projects, and so that's one of those things that's kind of a specialized project. But alright, so the first step in doing any of these capital budgeting projects is estimating the cash flows from the new project. And we estimate what are called incremental cash flows, which is how is it going to change our current cash flows. Chapter 12 out of your book goes into a lot of detail about how exactly to estimate these cash flows, and it goes into some specifics that are interesting and important, but it's mostly an accounting exercise. So we're not going to have time to cover chapter 12, but I usually am not a big fan of covering that chapter, which is in most of these finance textbooks anyways, because it's really an accounting exercise, not a finance exercise. Meaning it's book work. It's going through and doing the book work of figuring out what different accounts in the income statement and balance sheet are going to change if we take this project or don't take this project. Finance is more about making, after you've done the book work, making the decision. Is it a good project or not? Should we take this project? And so we're going to look at, in this chapter, what I'll call the financial decision criteria, which is we have these 5 different metrics, which are ways to measure whether or not a project is good. So a couple of these you've actually heard of, net present value and internal rate of return before. We did them back, I think, in chapter 5 on time value money. We're just going to apply them to a different problem, basically. And modified internal rate of return, we'll talk about that later, it's related. And then this payback period is a slightly different concept, but it's a really basic concept, so it's not shouldn't be that hard. Alright, so we'll start right in with net present value. So again, you should have heard of this term before. In chapter 5 we did it with uneven streams of cash flows. I taught you originally how to do it on the finance calculator, and then later I put up a video on how to do it on Excel, and on this lecture I'm going to do everything on Excel. So, because from what I've heard, the majority of you are doing things on Excel, which is great, because it's actually a much better way to do it. If you have access to a computer, you might as well use it instead of using the small calculator. But it's basically the same problem. We're just going to apply it to a capital budgeting problem. The interest rate we use will be our weighted average cost of capital, which is what we learned in the prior chapter. The weighted average cost of capital is basically the opportunity cost for a business. It's the percent that a firm has to pay to borrow money. That's your so when you discount all your cash flows, you need to discount it at what you need to pay out to your shareholders. And so we'll use that weighted average cost of capital. With each one of these decision criteria, I'll give you what I call the decision criterion, which is just for that one, which is, this is a rules basically that you need to know for each one, which is what's the rule whether we take a project or don't take a project. So for example, for net present value, as long as you get a positive net present value, that's a good project. That means that you're increasing the value of your firm. Net present value is actually considered theoretically the best of all these decision criterion. It's the best mathematically. It's actually the best, easiest to interpret. Meaning, let's say you have you take a project and you estimate its cash flows and you find its net present value, and let's say it's $50,000. And you can turn that into a per share basis if you need to, if you're a corporation. So you can divide it by the number of shares and say maybe that's $2 a share. Well, if your current share price is $50, basically what that means is if you take this project, your share value should go from 50 to 52. It should go up $2. So it tells you the amount, your wealth of your company, the value of your company should go up is by the net present value. So as long as it's positive, that should be a good project. Now, a lot of businesses wouldn't take a project if it's just slightly positive. You might put a buffer zone in there, but in theory, the rule is as long as net present value is positive, take it. I mean, it's increasing the value of your company. It should make your share price go up, which makes all your owners wealthier. If it's negative, you don't take it. I mean, if you took a negative $2 per share net present value project, that should make your share value go down $2. Why would you take that? All right, so we're going to do an example. This will be a running example. We'll do the same example with all of these different methods. So this basic example, let me explain it real quick. Say you have a retail operation. We can make it the shoe sales operation I mentioned earlier. Let's just pretend we sell shoes at a retail shop. And you're considering expanding by renting a new office or a new retail space at a new location, and you only expect to be there for 5 years. Most small businesses don't last that long. 5 years is actually probably long for most small businesses. They say the average small business in the U.S. fails within a year. So 5 years is a decent time frame to estimate over, and then don't assume you're going to stay there any longer than that. So in this case, we're going to assume we're going to be at this new location for 5 years. So we're going to estimate our cash flows over 5 years and not any longer. Let's say we did a marketing report where we might have hired an outside marketing company. Maybe we're a big enough firm that we have our own inside marketing. Whatever. We hired a marketing report. If you go look at the next chapter, they'll do a large accounting exercise where they go through and estimate what are the sales going to be each year, what are the operating expenses going to be each year, how's it going to affect our marginal tax rate, how's it going to affect, you know, all that kind of stuff. And then they figure out, we're going to take the cash flows as a given because we're really doing more of the finance side. So let's say these are the expected cash flows. So we have year 0, which is today, and there's going to be a large cash outflow today. I mean, we're going to have to stock the new store with new inventory, so that's going to cost. We're going to have to pay for advertising for the new store, things like that. So there's going to be a large cash outflow today, and then each year we're going to have a certain amount of cash inflow that we expect as from sales revenue. You can, if you're doing your own report, you can make this as detailed you want. You don't have to do per year. You could do it per month. Would be very common, especially if you're only doing 5 years. You know, do things per month. You could do things. It doesn't. Your answer is not going to change that much if you go from per year to per month. So, but we're just going to do it per year for simplicity, obviously. And then I've kind of given you a cash flow stream here that I think is kind of realistic for a successful business, which is it grows a little bit in the first couple of years and then it tapers off. You know, as you get word of mouth, your business picks up, but then at some point the word of mouth is gone. You can't get any more customers because you already have them all, and then they all kind of get tired and move on. So that's typical business. So let's say this is our cash flow stream. So it's going to cost us $40,000 to start this business. We're going to get $20,000 in cash flow, 24, 23, 17, 28, or 8. And then the question is, if your weighted average cost of capital, so this is your overall borrowing cost, this includes your debt costs, your equity costs, all that, it's 12%. So basically every dollar you borrow, you have to pay 12 cents. What's the project's net present value? And then the next question is, should you take the project? And then the next question, how large would the initial investment have to be to make this project infeasible? We're kind of going to do a break-even analysis here. Whenever you do any of these decision criteria, whether it be, sorry, didn't mean to scroll up there, whether we do net present value, internal rate of return, payback, whatever, you never really just do one analysis so you have one number and you say, oh, well, my net present value is positive, I take the project. You'd almost always do some sort of sensitivity or scenario analysis, which means you go through and you look at different possibilities and see, well, what would the NPV be if my sales weren't as good as I thought they were going to be? What would my NPV be if my inventory costs turned out to be higher than I thought they were going to be? Things like that. And so you end up with a whole bunch of NPVs and a whole bunch of IRRs that tell you sort of a whole picture of my risk and my return. So you'll end up with an expected NPV. You know, if everything goes the way I think it's going to go, this is what my net present value will be. If everything goes the way I think it's going to go, this is what my internal rate of return will be. And then what if things don't go as well, and what if things go even better? And so you can get a whole picture of it. So I want to get just a taste of that, because in this class we're not going to go through a whole scenario analysis or a sensitivity analysis, but we'll do just a little taste of that. Alright, I'm running just a little low on this first video. It's probably going to take us probably take us 3 videos to get through this one. So I'll go ahead and stop this video and see you on the next one.